Well, here we are, folks. Another cold Tuesday evening in sunny Wollongong. Actually, dark Wollongong now. It was sunny earlier on. Gee, it's cold. The dogs don't like the cold. Great to see everybody here. And we'll put the pre-show thing on there just to say hi to everybody. There was a lovely comment from Fraser just now. Are we going to church and to repent for daring to question the chosen one, Dr. Lowe? Well, somebody's got to. So we took it upon ourselves too yesterday because we're not convinced. So there you go. I will, of course, just give the dogs a bit of a show. There you go. They're both sound asleep. They do not like the cold weather. I take them out after the show and they look at me saying, you've got to be mad. We're not going out when it's so cold of an evening. But I do insist. So there you go. They are good. I have Damien ready to come in a moment ago. And we've got plenty to talk about. Of course, there's lots of interesting things going on in the markets and in investing land. And, are we at the bottom? Who knows? Will interest rates go as high as they were forecast to go? Who knows? A lot of uncertainty, so it'd be good to get Damien's take on it and see where we go. Anyway, I think that's enough of the pre-show, so let me take that off. I'm going to run the intro and I'll be back in just a moment. Stand by. Good evening and welcome to this live stream event on the 28th of June 2022. Martin North from Digital Finance Analytics here. Great to have you on the stream tonight and good to see some new names and some familiar faces back as well. So thanks very much for taking some time out on your Tuesday. Important conversation tonight. We're at the end of the financial year, of course. A lot of questions about where the markets are going and we're going to get some insights from Damien in a moment. As always, let me remind you that we're not providing specific financial or legal advice. This is a general conversation. We'd ask you please to play nice in the chat room. We do moderate the stream. If you're watching in replay, this is as at the 28th of June 2022. And if you're watching live and you want to ask a question, use that Walk the World. That'll make sure that I see it in my queue. And if you'd like to get your question at the top of the list, you can always use Super Chat. Or indeed, if you'd like to make a contribution to what we do here, that would be greatly appreciated. We don't do this for profit reasons. We do it because we think there's an important conversation to be had. Anyhow, with all that out the way, let me push this button. Damien, are you there?
I am, Martin. Good to see you.
Eureka, it all works. I always hold my breath when I push that button, just in case.
Yes, I know the feeling.
Yeah, and you sound a lot better than last time. I know you were battling with a few things last time around, so great to hear you back at full strength.
Yeah, it had COVID and then got the flu in quick succession, which was not highly advised.
Perfect timing,
but I feel 1,000% better than when those days. Yes.
Now, I guess just before we get into the meat of the conversation, there may be some people on the stream who haven't actually come across you before. So why don't we just get you to give the whistle-stop 30-second view of Walk the World, Nucleus Wealth, and what you're up to?
Yeah, sure. So look, I spent sort of 20-odd years in various fund managers and stockbrokers, and so know quite a lot about the way that the industry works. About 5 years ago, I started a fund to try and sort of resolve what some of the issues that I see. Basically, what I wanted to do was have a fund that the same type of fund that a super fund would get if they went to a fund manager, or a big investor would get if they went to a fund manager. They get to choose, what's in the fund and what's not in the fund, in terms of saying, I don't want to have any tobacco stocks, or I don't want to have any nuclear, or I've already got a banking exposure. Don't buy me banks because I already own them myself. So you get to sort of actually tailor it. But also you get to see everything that's in there and the reasons why. And so everything's extremely transparent. We run both active funds and passive funds as well. So if you just want an index fund with certain things cut out, we do that as well. And then it's probably about, must be a year and a bit now, Martin, we sort of joined forces, so to speak, and created the Walk the World Fund that provides all that sort of same service to watchers of the show. And so, more than happy to. We have a financial planner on staff to answer any questions. We try and do most of it all online to sort of bring the costs down, but with the idea that I'm podcasting, blogging, all that type of stuff to provide it all. But if you do need to speak to somebody, we have somebody there to talk to you and answer the questions.
Yeah, and just to say the world thing has been going quite well. The reason that I wanted this tie-up, and there's a mutual benefit, I think, but you guys are just so transparent, horribly transparent, right? But you can see what's going on, unlike many of the other super funds, and that's what I thought was a really good proposition, because there's no doubt about it that the concept of having a core investment, wherever the markets are going, a core investment that you've actually got some handle on is a really important element. You can speculate around the edge, but this is about the core, isn't it?
Yeah, absolutely. And for some people, that core and so all we're doing is buying large cap shares, government bonds, and cash, and large cap shares both internationally and in Australia. And so for some people, that's the whole lot. That it's like, what, I'm happy to have the high quality liquid assets, and that could be my whole portfolio. For other people, then they go, well, that could be 90% or 80%, and I'll just have a few assets around it. And for other people, it's 30 or 40%. So, but I think regardless of whether you're using us or somebody else, my personal view is having that idea that I have these core assets that's sort of going to sit there and provide that liquidity and safety and everything like that. And then around that, do the more risky stuff if that's the way you want to invest.
Right. Well, let's move on and talk about the market, right? I mean, the markets, what earth is going on?
Yeah, well, it depends on which day. I can't even remember where we were last time we spoke, but, it might have been an up week, might have been a down week. Certainly we're in the middle of an up week at the moment after a couple of down weeks. So, the month's still looking like it'll end up being a relatively poor month despite the sort of the big rallies we've seen. I guess a couple of things I'd highlight is, one is when you're in a bear market, and a bear market's one that's sort of falling over a period of time, like we have been in the last 6 months, and potentially sort of going forward, you do get some really big rallies in bear markets. Most of the time, like the biggest rallies the markets see come in the bad times, where the market will fall 10% and then it'll rally 5% in quick succession, and then you'll get another 10% downside and then another 5% rally, and it's that volatility that really I guess is very confusing and sort of and emotionally turbulent for everyone involved in it, because you sort of you're so upset. Oh, geez, the market's down 10%, and then you're like, and people then sell, and then the market rallies 5%. They're like, oh, maybe it's back on again, and jump back in just in time to get the next 10% down. So having that the idea that you really need to have a plan going into these things about, if the market does this, I'm going to do, if the market does X, I'm going to do Y. If the market does A, I'm going to do B. So that you've sort of got your plan around. Okay, so for example, for me, we've been heavily in bonds, which hasn't been a particularly good one for the first half of the years. It's starting to become a bit better over the last week or two, but lots of cash and lots of US dollars, and that's been working for us. And certainly the bond side's been working far better than having been invested in equities. And so we've got that big base. We're looking for the market to keep falling as it sort of reaches lower levels, and sort of, for us, it's about price to earnings and valuation metrics. But, at the moment, if the market was sort of 3,500-ish, we'd be starting to pick up, a fair bit. And it's sort of, 3,200 or whatever, we're starting to get back to a more normal holding, sort of based on our outlook at the moment. Having said that, things can always change. The fundamentals, it's about, where do those fundamentals change, and that's where, we're looking at the earnings and we have our plans. If the markets shoot up even higher, we'll probably, and depending upon what they do in terms of cash and bonds, we'll then be looking and trying to work out, well, are the fundamentals improving to justify it, or is this just another liquidity-driven event? And if it's liquidity-driven, how long can it last? And sort of those types of factors. So, but the idea of having a plan, so you're not just sort of sitting there going, I feel really bad today. Well, the market was up. Now I feel better. I better jump out and buy stuff. Is not a plan. It's more about getting that view and then testing that view and working out is it right or is it wrong.
Yeah, and the point about that is, of course, that there will be differences of opinion. I was reading JP Morgan the other day saying, well, end of the financial year, now the 30th of June, there's going to be some run-up and some truing up about, because people have to actually, close out things at the end of the year. They were suggesting that there could be a 7% rise in the markets over that period, but then it's going to come back down again. There are others saying, well, maybe the expectations of interest rate growth has tempered back a little, and maybe they won't go as high, and etc. And then other people saying, well, Powell's now saying he could cause a recession, and he may need to cause a recession. So, I mean, you've got this really diverse portfolio of views. And I have to say, I think they're all making it up because nobody quite knows.
Well, that's right. So you're asking me to make something up, Martin? Is that what I hear from you? Asking me
no, I regard you as the oracle, Damien.
Yes. Well, I think as in my experience, as soon as you start regarding yourself as an oracle, is the first step to losing a lot of money.
I'm not. I'm just. But I'm interested in your perspective, right?
That's right. I'm not taking it seriously. But having said that, from that perspective, every view you have, you need to have a basis to it, but you can't hold on to these things too strongly, and that's I think there's always that part for everyone about saying, I need to work out what will actually prove me wrong, because it's very easy as you go through these. Let's say you had a bullish outlook at the start of the year, and you're like, well, the Fed's still pumping lots of money in, and earnings is going great guns, and unemployment's going to record lows, and the market's going to go higher. Is that there's there's this part from an investment perspective, as something happens, market falls Russia invades, market falls 5%, and then all of a sudden you're looking at portfolio going, well, yeah, okay, if it had been 5% higher, I would have sold, but actually it's fallen far enough now that I'll keep holding on. And then you get the Fed start raising rates, and then you get economic growth start slowing down, and then you get interest rates going even faster. And each step of the way you can keep justifying, well, yeah, it's already fallen, but so I'll just keep doing what I'm doing. You've got to pre-call your shots. So this is what my view is. If I'm wrong, then these events will happen, and then I have to admit I'm wrong. So from that perspective, I'm in terms of what's happening with the Fed. I think you're certainly in this period where it is the most important game in town, and everyone's trying to speculate as to what's going to happen. From my view, it is very likely that they're going to cause a recession, partly because they almost always do. Like it's very hard to generate a soft landing. If they do manage to generate a soft landing, it'll be one of, I don't know if they've got one or two maybe in their history where they've managed to do it. And even those ones, the argument is how much of it was their fault and how much of it was outside forces that caused it. So almost always the Fed is watching inflation and watching unemployment, and they're two of the more lagging indicators. So what happens is economic events happen, things start heating up or slowing down, and the Fed's raising rates or lowering rates to meet it. And it's not until they get to the stage where they're like, oh, okay, they're raising rates. They go, oh, things have finally started to slow down. Great, we can stop. Well, interest rates have about a 12-month lag. Yeah. Could be 18 months, could be 6 months. But, they've already gone too far, and almost always, it goes into that period where they'll cause a recession or something will break. And when I say something will break, sometimes it's you Lehman Brothers and things like that. Sometimes it's large corporates going broke. This time there's a whole range of different places it could be. It could be emerging markets. We've already seen Sri Lanka have a debt problem. On its own, Sri Lanka is not enough to sort of bring things down. But if you start seeing a bit of a domino effect, that could happen. Maybe there's just the massive losses we've seen in Bitcoin, or we'll see actually some really large scale blow ups that sort of burn a lot of money there. That could be the start of something. There's lots of corporates that are overgeared, so that could easily be the start of something there. So that a whole range of different factors. I could go on and on about potential things. But almost always it's the effect of this raising rates that does it. So when you can borrow money at almost for free, there's a lot of business plans that look really good with free money. As that cost starts to go up, all of a sudden you start to see which companies were really just relying on financial engineering and which ones actually genuinely have a business. And when some of those start to fall over, you can cause much bigger problems throughout the rest of the country. And we're starting to see already, a lot of developers. I'm sure you're keeping an eye on them, Martin.
Another one.
I feel like
another one
the
down in
list
Melbourne
is
just turned over. Right, about another 70 is expected to collapse in the next month or two.
Yeah, that's right. I think you're well into the well into double digits, as you said. I think we're getting close to triple digits in terms of some of those. So, and that's the type of thing where it can spiral out of control, and it's too late for the RBA once they start. Once these events happen and they start trying to put the genie back in the bottle, so to speak. It's they work with a lag, and so so that's where that's sort of my. I feel as if I've spoken for a long while, and I'm not quite sure I've answered the full question.
No, but the lag question is really important, right? Because if they're going to lift rates every month for a number of months, right? I don't know how they can calibrate the impact on the markets, right? Because a lot of the data is lagged by at least 3 months before they see it, right? Like inflation, for example, right? So
absolutely.
No, they seem to be relying in Australia on sort of their network of liaison, right? But there's been a few articles saying, actually, this liaison stuff, it's pretty limited, and they're not really talking to that many people, and, are they really getting the right story? So are they flying blind is my question, Damien.
I wouldn't say completely blind, but I think they're certainly flying with very, very limited visibility. And not because they're not trying. I think they're obviously trying, but, Australia's, the first problem in Australia is, as you said, we've only got 3 months reporting of inflation. That's sort of you would think is a bit of an oversight for such an important measure, especially now, given how much debt we have, and that's the prime thing for it. And then the other, and keep in mind as well, these things all get revised backwards in time anyway. So people go, well, we thought this was, we thought GDP growth was 1%, and by the time they've got to revise it down, it was actually minus 0.5% or something like that. There's a wide range. In terms of those revisions as sort of more data comes in. So in terms of the RBA, the other one I was going to say on the RBA was, the bigger problem for me is it seems as if they're talking about, bringing down this inflation part. And this is the kind of thing, we're going to raise rates, we're going to bring down inflation. Well, a lot of it is the energy. And we haven't even started on power prices. At current power prices, we're going to double the cost of power in this country, and that's roughly 3%. So it's going to double our inflation. From that, how high would they need to raise rates to bring down power prices? Well, power prices are driven by the international cost of coal and the international cost of gas. So you could cause a depression in Australia and barely make a dent in the price. So that's not affecting it. Most of the food cost problems we have, some of it's fertilizer related, but most of it's the floods. That cause problems right up and down the East Coast. Raising rates doesn't fix that. That's just possibly makes it worse for some of the guys trying to. So I guess you need to be careful about what we're trying to. What are we genuinely trying to solve? Do we have a wage problem in Australia? Not yet. And it seems that there's a lot of people actively working to make sure we don't have a wage problem,
including Mr. Lowe himself.
Yeah, absolutely. And it's this part about when you look at company earnings and you're sort of like, okay, so company earnings are really high, so profits are great. We've never done better in terms of that. Yep. Wages are quite low, but inflation's high, and so what that's saying to me is, well, companies are putting up their prices. They're not putting up their wages, and they're keeping the profits. Yep. So is that a good thing? Like, you can't complain, workers, you guys can't have too much of a pay rise because the bosses need their profits.
Well, there's an interesting logic, right? Because for many years it was inflation's really low, so you don't need pay rises, right? And now they're saying inflation's really high, but we can't afford to give you pay rises, right? Spot the common theme, right? And at the same time, businesses are continuing to be very profitable. In fact, if you look at the growth of profitability of businesses versus wages growth, it's like, there's light between them, right?
Yeah. But they're going in different directions. It's not even like it's not like one of them's going behind. They're just
it's like
different directions.
Yes.
And so does that mean you should be buying stocks? That's an obvious question from that. Look, the problem you've got is it works really well for a period doing that until it doesn't. And so and the reason why is when you don't give people enough money, they can't get out and spend. And then the first bit is you don't pay people enough. And so then you let them borrow at really low rates. So they don't really notice that they're not being paid well enough because they get to borrow to fill the gap. So, here you go. Here's a really cheap loan to buy a car. Here's a really cheap loan to buy a house. You still get to live the lifestyle that, but we're just not paying you enough and we're letting you borrow instead. So that's the first step. But then once you run out of borrowing room and once you start raising interest rates, that doesn't work anymore. And that's the problem is if you're in that scenario and you reach the end game, then you've sort of painted yourself into the corner and now you've got to live with the consequences. And that seems to be the way we're going at the moment is, rather than encouraging pay rises and encouraging companies to take a little bit less profit, it seems that, no, we've got to maintain those profit margins at all costs. So the problem is, though, as interest rates go up, and if we see that all of a sudden demand start to hit, that's where corporate profitability can really fall. And because we're at such high levels, that's where you get the danger. So I'm not expecting a massive fall in profits at the moment. I don't think it'd be nice to say there's we're going to go through this therapeutic, change in the way society works, and we're going to pay people more fairly, and companies aren't going to make as much profits and all that type of stuff. I don't think that's going to happen. I'd love it, it'd be great if it did, but the reason why we're out investing is because it's probably not going to happen. But are we going to run into a demand problem where companies are forecast at the moment to grow 10% 2022, another 10% in 2023? So do I think there's another 20% growth coming in the next 18 months? No, I don't think so. I think we're going to see those higher interest rates start to bite. We've already seen massive increases in mortgage rates in Australia. Same's happened in the US. You haven't really seen the effects of that. It's only really just starting. And as those effects start to build up over the next sort of 6 to 12 months, I think you're going to really see some serious dents in corporate profitability.
Yeah, and it's worth just looking at that mortgage rate, right? This is the US mortgage rate, which is knocking on 6%, right? Which is higher than it's been for a long time. Now that's the fixed 30-year fix. So effectively, it's new loans being written. A lot of people already have older loans at lower rates, but that's a very important forward signal, and it's already having a dent in the US on property. Sales volumes are down, property prices being slide. One of the surveys that came out the other day in the US was highlighting the fact that in some locations, demand has really dropped away dramatically and prices have started to move significantly down. And I guess the question is, the Fed might be okay to see the markets down a bit, but are they going to be able to handle a fall in the property market? And I guess we can also ask the same question here as well. Well,
the problem here is more acute, though, because, and as you said, the US, a lot of people, for anyone who doesn't sort of know how generally mortgages work in the US, is that if you went out and got yourself a mortgage 2 years ago, you got a 3% rate for the next 30 years locked in. When interest rates are now at 6%, you don't have to pay 6%. You're locked in at 3% for the next 30 years. And there's not a reset. It's not like an Australian one where you're either on a 3-year fixed rate or maybe a 5-year fixed rate. You're going to get, in the US, existing people who have got their loan, they're locked away, they're safe. It's all at the new part. So yes, people stop buying new houses because yes, I can afford it 3%. I was looking and all of a sudden mortgage rates are 6%. I can't afford double the cost. And so it slows down more gradually. Whereas in Australia, the effect is, yes, okay, people who want to take out a loan are hit, absolutely. But also existing people people on a standard variable rate get hit almost straight away, and the people on a fixed rate will gradually get hit. And that's, we're looking at that I think the next 6 to 12 months is correct. There's
500 billion is what CBA is saying. 500 billion, right? So there's a large amount coming through where they're going to reset from a low fixed rate to a higher fixed rate. And that's not just 0.5% increase. That's going from 1.99 to 4%.
Yeah, exactly. And that's a lot of people who are just going to they're going to get the money from somewhere, so they're not going to eat out as much. They're not going to do as many leisure activities. Whatever it is, there's going to be a whole bunch of discretionary spends that they're not going to do, and that's where you slow the market. And as you said, we've had this rapid rise in interest rates, and we're still the plan seems to be to keep jacking interest rates. and the effects of the current ones aren't going to be seen for another sort of 6 months. So will they go too far? Quite possibly, yes.
Yeah, very hard not to, I think. Now, there was an interesting question that came through from Kieran a little while ago, which I'm going to put up now, because it goes back to this issue of EPS and, returns, right? Because you mentioned that profitability is quite good. So does that mean that stocks are cheap?
No, it doesn't mean they're cheap. So what we've done is we've gone from a period where they got extremely expensive, but we had all this liquidity sloshing around. So they're basically as expensive as they've been pretty much ever, but they're sort of based on the amount of liquidity and low interest rates. There was some justification to be buying it. As the liquidity is all drained out of the market, so we've gone from being super expensive to being towards the top end of expensiveness now for a normal market. And that's based on getting 20% earnings growth over the next 18 months. If we don't get that, then actually, let's say we had flat earnings didn't go anywhere over the next 18 months, then markets would actually look quite expensive. They're back to that. Not so in a price to earnings perspective, we've got over 20 times, which is usually the mark of a super expensive market. At the moment, we're at 16. That's sort of the top end of the range. If we had lost sort of 10, 15% out of our earnings, we'd be back up to 18, 19 times. That's well above what a market would usually trade at. So the flip side is, the market could obviously fall. So I guess what we're thinking is, well, if we've got at least 10 to 15% downside in earnings, that you wouldn't expect a market to be trading at top multiples in that scenario. That gives you a more sort of brings you back to a more reasonable level. You stick on another 10 to 15% below that, and now you're starting to want to be wanting to buy that. And a lot of this so depends upon if the Fed tomorrow goes, oh, actually, you know what? We decided we got it wrong. We're gonna keep spending. Similar to what the Bank of Japan is effectively doing that at the moment. They're not saying they got it wrong. They're just saying we think this inflation isn't going to last for very long, so we're going to keep doing what we're doing. If the Fed flipped around and did that, there's probably a reason to get out and buy the market at the moment. But I don't think they are anytime soon. They seem to be pretty set, and most of the time central banks take a fair while to change around with their thinking. And so I think in this case in particular, with unemployment rates so low, I think they feel as if they can keep jacking rates until they see the unemployment rate really start to take a hit.
Yeah, and talking about central banks, it was interesting. The RBA did their report a few weeks ago on yield curve control and basically concluded, well, it sort of worked, but it didn't, right? But there was an earlier review done by one of the Feds in the US looking at the Australian yield curve control. Their conclusion was much more damning, which was saying it was a very narrow channel, and it didn't actually have spillover effects, but actually, they basically said it really wasn't that successful, right?
And it ended so badly as well.
Yes.
Oh.
Yes.
Yeah, we'll get into that in a minute. You keep going with the question. Then I'll talk about how bad
that's
it ended.
sort of where I was heading. So there are examples when the RBA has actually failed quite miserably to do what it set out to do, right? Another example of that would be the no rate rises until 2024, right? And then, of course, a couple of weeks ago, well, I didn't really mean that. What I meant was, if nothing else changes, then we'll, So, and we know that there are lots of people who basically make decisions based on the back of what was said back then, right? So I guess the question I've got is, not only is the RBA slow to react because the data's slow to come in, but are they actually mispositioning? In other words, can we actually trust them? Do we actually think they know what they're doing, or are they actually making it up as they go along? And I guess the questions to the Fed too, are they also, trying to do their best, but can they actually do what they're trying to do without breaking anything?
Yeah. Okay. So that's. Let me come back to that because I just want to go into a slight detour. So one of those things. For me, it's talking about credibility. So as you said, the RBA came out and said we're going to keep these rates low for until 2024, and so the first part of that was for investment markets. Basically, they said we're going to lock these in, and then the markets effectively just went, well, we don't think you can handle it, kept on pushing up rates, and then the RBA just let it go. They just let rates go up, And then it wasn't until rates had already risen that they turned around and went, oh, okay, well, maybe we're just going to let them go. As opposed to, like, I feel as if their credibility would have been much better if they forced the rates back down to the level they said that it was going to be, and then they said, you know what, we've changed our mind, we're going to let it go, and then step back and let it go. Whereas now the RBA's got this credibility problem, because next time when they say, oh, we're going to keep rates low or we're going to keep rates high for this amount of time, they've lost that credibility. Like, it's nobody no longer will investment markets just go, oh, well, let's price that in because they said they're going to do it. The Bank of Japan showing, I guess leading the way in terms of, the international markets are really trying to push Japanese yields, and they've basically said, no, this is what we're doing, and we'll spend what it takes to defend it.
Yep.
And which is what you'd expect from a central bank. And as I said, not to say they can never change their mind, but they should change their mind from saying, we did what we said we were going to do, now we've changed our mind and we're going to do it, as opposed to saying, we did what we said we were going to do, and then we let the market do whatever it wanted, and then we decided, well, the market seems to be pretty keen on that idea. We'll just go with whatever the market says. So that's that credibility side, where the next time round, it's going to be harder for them to do yield curve control because, they had the problems this time. The Fed's got a bit more, the Fed's got a lot more credibility on that side. I think they sort of didn't let the market sort of push them around too much. The decisions were made more themselves. Okay, so that's sort of a bit of a sidestep.
No, but very important, because it does go to credibility, and I agree with you. The credibility of the RBA is distinctively worse than that of the Fed. I actually think Adrian Orr in New Zealand, has actually had a clearer path and a more open communication path than the RBA, right?
Yeah, absolutely. Yeah, no, I feel as if the New Zealand central bank has done a pretty reasonable job in terms of doing what they say they're going to doing, reacting
despite killing the housing market and everything else. But that's another story. But the point is, from a central bank strategic communication and strategy perspective, it was pretty clear, and they've been holding to their path. Whereas the RBA, it seems to me, they got blown off course and have been sort of wobbling all over the place, and then. Lowe comes up on 7:30 and sort of gives a bit of a funny interview, and then says something different later, and you think, credibility? I wonder.
Yeah. Well, but he almost did it himself, didn't he? Like, he said, yeah, okay, so I promised, I promised low interest rates for people buying houses, but why should you listen to me? I might change my mind.
Exactly.
It's like saying, well, just a minute, isn't that? Isn't that one of your tools? And is you being able to tell people? I mean, because the net effect for the Fed, for a lot of the things it did, it didn't have to spend money, because it just said it was going to do it.
Yeah.
And then the markets went, well, if you say you're going to do it, then we'll trust you.
Yeah.
So then, buying corporate bonds was a good example of where bond yields started to spike.
Rates moved well ahead of them doing anything.
Yeah, absolutely. And so, so that's a great example of where the corporate bond market would have run into real problems in the financial crisis. Companies would have been falling over, just not being able to get any loans or whatever. And so one of the things they said is that, okay, we'll buy those loans, and this is what we're going to start doing. And then yields came straight back in, and they didn't even have to do anything because they said they're going to do it, and the market believed it. So I think there's hopefully there's. Well, you would have hoped that the RBA learned some lessons from that, but it's unfortunate that's where we've ended up.
And of course, there is a review of the RBA going to be done eventually, terms of reference still to come, and it's going to be including some external input as well as just being done by the RBA and Treasury, which is what they wanted.
Yes. Yeah, I know. That's I love to mark my own homework as well, but unfortunately,
it's not quite the way to do it.
It's no, that's right. It's if you want to get better, you need somebody else to mark your homework and actually give you genuine feedback, and and be serious about it's very easy to overlook your own sort of mistakes. Yeah. Luckily, I'm in an industry where I get marked every single day on when doing a good job or a bad job, and
you've got a horribly transparent a version of it, right? So there's no hiding. There was this question that came in just now, which is, do you think the RBA is worried about the impact of a low Aussie dollar and capital flows to the US as Jerome Powell continues to hike beyond what the RBA is really prepared to do? And I guess that links back to a sort of another part of it, which is, to what extent is the RBA anyway just aping what the Fed is doing. I mean, do they really have their own strategy, or are they really just saying, "Oh, right, we'll follow"?
Yeah. Well, I mean, it has been the last 10, 15 years, it's been beneficial for Australia in terms of we have been sort of a bit behind what everyone else is doing, and so we can sort of just our growth's was higher post GFC and falling behind everyone else's, and so a lot of it was just sort of having a look what other countries were doing and following that with a lag. So I think there's an element of that at the moment. I mean, the interest rates that are priced in, interest rate rises are still higher in Australia than elsewhere. Now, it's hard to say exactly why that is. The market's obviously a big place and everyone's got different views. My take is that it comes down to a lot of international investors sort of looking upon Australia and saying, well, with the Ukraine out of commission, Australia does a lot of wheat. They do a lot of oil. More gas. They do some oil, but mostly gas. A lot of energy and a lot of coal. And so, and they're all things that they're either cut off from Russia or substituting what the Ukraine could publish. So Australia will be a net beneficiary, and so therefore growth will be stronger in Australia than elsewhere, and so interest rates will need to go higher.
Yep.
So I guess my counter to that, and that's at face value sounds reasonable. My counter to that is that on the energy side, the coal is very beneficial for Australia. The gas is not that beneficial, I don't think, given the size we are, because most of it, like we're just not getting any tax revenue out of it. That's where we're years or decades away from getting reasonable tax revenue out of that. So it doesn't really affect the government coffers, and most of the companies are foreign owned anyway. So it's not really affecting that many local shareholders. Chevrons and Exxons and all that. So that's not having as big effect in terms of the coal side. I do think the coal. Sorry. Why I was focusing on gas is because gas is one of those things that's actually quite hard for Russia to get anywhere except Europe. So they just don't have the LNG. They don't have the pipelines. It's quite hard to get out. Coal's easier. Coal is, there are train lines. China will take the coal. So there is sort of more potential for Russian coal to sort of end up there. I think as well, Russian wheat is likely to end up in India. It's likely to end up in China as well. Like it's a bit more of just a shuffling around. Maybe it spends longer on a boat than it would have. But the cost there will be sort of won't be as high as what it will be in the gas market, for example. So my take is I think there's a lot of commodities that will end up from Russia in China or India and they're very, very big markets, obviously by population size, which will just mean a lot of the commodities is just shuffling around the world rather than creating these massive shortages in various areas.
Yeah, that's exactly right. And the commodity link to Australia is definitely underpinning, isn't it? Underpinning our economy compared to many others. And that's something which I think many people have yet to fully comprehend. Although, of course, China is coming off the boil a little, and we export, 37% of our stuff to China. So we've got a bit of an issue there, but there is still quite a lot of other countries that may well be knocking on our door as well.
But on the commodity side as well, effectively what the Fed is saying to me when they say they're going to raise rates until we slow the economy down, they're saying we're going to break oil and we're going to break commodities. Yep. They're the two things that are still high.
Yes,
so we're going to keep raising rates until we bring them down.
They're the inflationary drivers, so you've got to turn them off.
Yeah. Exactly. And so it is hard to see. Well, it could happen, but I think the odds are that the Fed will keep raising rates until it breaks oil.
Yep.
Is my expectation.
Yeah, because that really is the cornerstone. And it's interesting because Yeti1 asked this question, which sort of flows in. How does current and coming world food shortages and food protectionism factor in the conversation? For example, India's just announced it will not export sugar, Malaysia, chicken, etc. I mean, there is this sort of de-globalization thematic, isn't there? People becoming more protectionist, trying to look after what they've got. that could have a significant impact as well, I guess.
Yep. And so, fertilizer costs are sky high, partly because Russia's a big producer of it. But again, I sort of feel as if that's a lot of that will end up in China or India. And so it's not as, rather than going 200 kilometres to get to Europe, it'll end up going 2,000 kilometres to get around the other side of the world. But it'll still sort of get pushed around. But the bigger issue is this gas prices really pushes up the price of fertilizer. And so that's causing farmers to say, well, if it's going to cost me this much to buy the fertilizer and increase my yield by 20%, but that's not worth it because I'm going to get more if I just plant less and don't pay for the fertilizer. So if that is genuinely happening at the moment. So what that means is lower amounts of food. It's probably not that bad for a country like Australia and most sort of developed countries. Could be devastating for a lot of the emerging markets because what tends to happen is the costs in Australia aren't that high as a percent. Like you're paying most of it. You're paying your transport. You're paying for your barista and your your rent and all that type of stuff and the wages. Like that's way more than the cost of the coffee bean in your cup of coffee. Or the wheat in your bread. So yes, Australia and developed countries will do fine. We'll just pay a little bit more, but emerging markets will cop it. And the problem there is exactly the stuff you're saying is you'll start seeing bans on things, which will create other shortages in other places. But last time this happened, was Arab Spring. You do get genuine political need to change when people are starving, and so could this lead to a world? Certainly an emerging markets world where you've got more, a lot more political turmoil. Absolutely. I'd say that's probably the base case rather than, like a risk case as it usually is. It's always there that, okay, maybe something will happen in a country somewhere that'll blow up and cause problems. Whereas I think now, the base case is, the way food is looking is that there'll be problems in some countries, emerging market countries. Yeah.
Well, let's come back to the energy thing, right? Because the energy thing is worth spending a bit more time on, I think. And obviously, we've got this local issue with power. They sort of fudged it, but they've sort of managed to get away without blacking anybody out. But we've actually got a couple of energy markets or 3 energy markets. When you look at it across the country, right? And some of them are doing better than others.
Yeah, that's right. So, WA, let's use WA. We've got WA, Northern Territory, and the whole East Coast. The whole East Coast is sort of effectively your 3 different markets in Australia. And WA looks pretty good at the moment. Their prices aren't, they're a little bit higher than usual, but sort of talking more like, actually I haven't checked in the last couple of days, but, it's more like sort of $60 or $70 per megawatt rather than 50. Whereas on the East Coast, we're talking about, $400 and $500 a megawatt. So so there's a couple of issues there. One is there's a lot of talk about the East Coast and how we've got to where we got to, and to fix this problem, let's do more of the same as what we've done. And so
definition of insanity.
Yeah, well, there doesn't seem to be a lot of what did they do over there? Why are they doing all right and we're not? So, I really haven't seen hardly anything on that. So we ran a podcast on it just the other day to talk about, why. One of the interesting ones in WA, they're actually tearing out a lot of the poles and wires. Now there are some issues with, you do need some more transmission assets and stuff like that. But generally speaking, we had on one side of the country saying, hey, we're going to, one of the 3 fixes to this problem is going and building out more transmission assets. And on the other side of the country that's not having the problems, they're like, we're going to keep ripping out transmission assets because sometimes they're too expensive and we're better off just having local microgrids. And so I think we've spent 20 years at this. Like, we've we privatized the whole energy market. And what keeps happening is the energy guys keep on ripping us off. And so then we have to put in new regulations, and then they rip us off in a different way. And then we put new different regulations in, they rip us off in a different way. And it's sort of that question about saying, well, maybe we would have been better off with at least a chunk of it being publicly owned, monopoly assets. If you're going to sell it to private operators, then you've got to spend the rest of your time policing those private operators to making sure they're not ripping you off. And maybe it's better off, for all the effort you've spent, given we've obviously got a broken market at the moment in the East Coast, maybe you're better off, having some of these assets as being publicly owned, at least to sort of so you know what's going on in those some of those markets. And when private operators turn around and say, oh, sorry guys, tough times because it's got to double our prices, is you go, well, how come the public guy doesn't have to double his prices? So I think that's
so transparency and simplicity of outcome, right? It is rather messed up when you've got a sort of a market mentality over the top, and when the primary outcome is actually value to shareholders, not providing service to communities.
Yeah, exactly. And the issue with the electricity market is because it is this monopoly asset that whether I choose to go with whichever retail company that's selling me my plan for electricity, I don't get different electrons. The same electrons I was going to get from either of them. It's all it is a marketing charge added on top of it. We've got what we've effectively done is said, let's create competition because that'll drive down prices. That's really, if we've got competition and private companies involved, we'll be able to drive down prices. The issue is that it hasn't driven down prices, and there's there's so many cases where we're spending so much effort trying to force a competition in a market that doesn't have any natural competition. I guess it's different for it's different for lots of other things that you buy because there are genuine choices as to, so saying if you're going to fly on an airline, you've got a genuine choice. I don't have to fly Qantas or whatever. There's a whole bunch of different airlines I can fly on. So there's genuine competition. I don't need a government-owned one running it. But the airport, okay, I'm flying out of Melbourne Airport. That's so then they're going to charge me $40 to park in a cow paddock. That's they're a monopoly. They can do that because I've got nowhere else to go. So that's where. Yeah,
the analogy I use is the sewerage system. We all need a sewerage system, right? What we don't want is competing sewerage systems, right? I mean, it's going to be awfully messy, right? So there are things, infrastructure things that we just need one of that's delivering effectively and as cheaply as possible without a significant profit motive sitting over the top, because the profit motive actually contaminates making the right decisions.
Yeah, and the thing is, you can always have outsourcing in some of these. Like in the energy market, it's fine to say, okay, I'm going to buy my energy from different places. I'll buy it from this coal-fired plant or that one, or they can be privately owned and things like that. But when you've only got one person or one entity doing it, then then that's where it's a monopoly positions you need to work out. Is it worth the effort of trying to turn a monopoly into a competitive market, or is it better just saying, well, look, the government might be less inefficient. Might be more inefficient, but at least they're trying to do the right thing by hopefully trying to do the right thing, and so it's an offset of
And anyway. The other point to make is that we've had this ideological view of short-term capital creation. Right, because we got short-term budget issues in our states in particular, right? So let's sell off some assets because that gives us money we can then play with and keep our budgets under control. So we almost cut our nose off despite our face.
Yeah, absolutely. And I think there's the part where it's this low-hanging fruit problem where the first couple of privatisation were great. There were genuinely companies that the government owned that they shouldn't have owned, but as you go through, you get rid of all those quickly, and then you start getting into the ones you shouldn't be privatising. And another great example I'd use is the coal seam gas sort of fits well into this. Is that coal seam gas is sort of this big boom in the financial crisis. That area was booming at the time, and all the best assets were the ones that got bought out first. And so you'd see. You've got this company that's got all these great assets, and so it gets bought out at this high price, and then everyone takes their money out of that and goes, this coal seam gas is still going great. Let me go buy another one of those companies. And then as they went, each company sort of got worse and worse and worse. And so by the time all the good assets are buying, there's a lot of investors out there chasing these really dud assets because they're like, I'll just buy this and it'll get taken over by Chevron or one of these other guys who's trying to buy up all these companies. And it's under the false assumption that what's worked before will work again, and end up losing a lot of money on those ones. So it's that same idea, is that just because something's worked the first few times, you do need to seriously question: is it just taking low hanging fruit and you're going to run out of that, or is this actually got a genuine thing that's going to keep driving profits forward.
Yeah, you need. There's a strategic decision matrix that actually you need to put stuff through to say, is it in the right quadrant in terms of actually, creating the value, or is it actually something which is really fundamentally important to society, but actually really you shouldn't let profit get in the way of it, right? And unfortunately,
absolutely.
What we've done is we started up there at the top, but we worked down into assets that actually should never have been sold in the first place, right? And by the way, if they looked around the world, because our history of privatisation is behind, say, the UK or other places, right? They were already going wrong. Look at the privatisation mess of railways in the UK. I mean, there were plenty of examples, right? If they had but looked
somewhere else, yes. So the net effect, though, of all that is it doesn't look like anything's really being done on the East Coast. So that means, and for the talk of, something was shut down, offline, maintenance, whatever it is you want to talk about, the net effect really is that coal prices are at levels that justify much, much higher energy prices. Gas prices are 10 times their normal rate. So we're going to have, while you're using coal and gas, and there's no quick way of getting off those, we're going to see high prices. The alternative is you can put on what Europe did, the UK did, in terms of saying, here's a super profits tax. Yes, there's a war going on. You guys are making effectively, super normal profits because of the war. We're going to take those profits and recycle it back to people to be able to pay for this electricity. But it doesn't seem that's happening over here. And so, high energy prices, get ready for it. It's only just started.
Yeah, exactly. It's going to get a lot worse, isn't it? And a lot of people are going to feel the pain. And, there'll be a lot of weasel words and et cetera, but I don't think there's any way out of that because we've laid a bear trap for ourselves over at least 20 years.
And so I think that's going to help the RBA so that they won't have to raise interest rates as much because they've got this handbrake coming through from energy prices. That's going to, and so we've obviously got our petrol prices. That's all that's they're pretty high as well. So you've got a number of different and in general inflation in food. A lot of that's sort of driven from the floods, but that's.
Well, let me just put this one up because this is a slide I put up the other day and people fell off their stool. This is actually the latest data for basic food prices in the Illawarra, right? And they've tracked it at Aldi, Coles, Woolworths and a local store. And they're looking at 20% up over not just a year, but over the last 3 months, right?
Wow.
And that's the sort of stuff that I'm seeing in my surveys. So a lot of people are already squealing because of these huge lifts in costs. And now when you overlay fuel and electricity and those other things we're talking about, let alone interest rate costs, this pincer movement is very significant on households. And I struggle as to why it is that there's a bit of lip service, but that's all. Now, there isn't really a full understanding, particularly those in power, of just how bad it is out there.
Yeah, that's right. No, you shouldn't have 5% pay rise there. You can only have a 3.5% pay rise because otherwise inflation will get out of control. So and so as you said, this all feeds back into one thing for me is that the economy is going to slow a lot faster than what interest rate markets have priced in, and so it's all going to make a dent. And it is worth noting as well for food though, and the question is how much of this comes from the floods and short term issues, because you can get some quite sharp reversals in food as well. And actually, the other thing, just from a global perspective, is energy markets are quite concentrated. Your oil is mainly from Russia, it's mainly from the Middle East. Gas is mainly from Russia, Qatar, US, and Australia. You get some disruption in one or two of those, and it makes a huge difference. Food's a bit more malleable in terms of one crop. You're out of wheat from Russia or the Ukraine. In the US they can grow something else, or farmers can switch from saying, okay, I'm not going to feed my cattle that, I'm going to feed them something different that's cheaper. And there is, I guess, we're much more used to disruption in the food market because droughts happen, floods happen. frequently, and so they move up and down a lot more, and which is why the RBA generally takes it out of their price indexes when they're looking. But it is one thing, as you said, to take, you can take them out of your price index and say, okay, I'm not going to influence that. I can't undo the floods, but you do need to recognise, though, when people are feeling the pinch, as you said, from multiple places at once.
And there's another thing just to bear in mind, right? Because inflation is measured as a delta, right? It's from point A to point B to point C to point D, right? But if you go up and then prices don't continue to go up but stay up on a high plateau, right? Actually, over time, the inflation number comes down, but the actual amount that people are paying don't come down.
Yeah.
Right?
Yeah,
and that's an important thing to understand, because they're targeting the delta, not the absolute cost.
Yes. Yeah. And so, and that some of the tough thing from that is this obviously substitution, and that goes on as well in that you can often, and I don't want to say that, I do generally think there are big price movements in a lot of food issues at the moment, but you can see quite often sometimes that people will go, okay, here's 5 things that have all increased in price, and here's 3 things that haven't, recognising that the 5 things used to make up a big chunk, but then people just switch. So let's say when bananas went from whatever, I think we had the cyclones and they went to $10 a banana or whatever they went to. For people to say, oh, well, Martin eats a banana a day, and so therefore his costs have gone from, $5 a week to $70 a week, is like, well, no, that's not true, because Martin didn't want to pay $70 for bananas. He switched and bought apples that week instead. And so, food inflation
there's things you can
tough.
switch, but you can't switch petrol.
No,
right?
that's right.
You can't switch electricity. You can't switch gas, right?
And when you've got broad-based, leafy greens, and it switches so that one of them's up 30, lettuces are up this much, but then everything else increases because people aren't buying those ones yet.
So where I was heading was, it could be that in the middle of next year or end of next year, the official inflation rate starts dropping, right? Because the rate of change is actually not continuing is going to come back.
Yeah,
right? And then you have the base effect as some of the other stuff drops off. But if you're at a high plateau, you're still paying a hell of a lot more than you were, right? Which basically means, okay, RBA can say they've done their job, but actually for the real households, it's not actually working.
Yeah, that's right. And at that stage, companies will turn around and say, sorry, Martin, things are tough. No wage rise for you.
I know.
So, I
know. Jason, just a quick acknowledgement. Thank you very much. And for the other super chats too from the other guys there, really appreciate it. And thank you very much for helping us out. Now, Damien, we're coming into census season, right? And we've had the census last year. We've started getting the results. They first came out. One of the most interesting, eye-catching ones for me today was the more than 1 million vacant properties across the country. 1 million plus, right? And I'd also make the point that those 1 million don't include all of the properties being developed at the moment, so all those high rises. So it's probably closer to 1.2 million. Very interesting question then about, is there really an undersupply of property, right? Because with so many spare properties around the place, interesting observation on the way that the market's actually behaving.
Yeah, I should have got my stats, but I had something from the last census where you basically looked at the proportion of people that had empty houses, the number of people per household, and a few other things, and you can basically change everything in the second decimal place and get an extra 200,000 or 300,000 houses, here or there, because the numbers are so big. You just need to, so that's what, whatever it was. I think if you went from 11.5% back to 10.49% or something like that, and the other way, 11.49 back to 10.5, you have quite a big fall, but you don't even see it because it's all rounded, and so it's talking about big numbers, and it's this issue again about, I don't want to bring everything back to inequality, but I do think it makes a big difference, is that, for a lot of people, the more money they get, the first thing they want to do is buy another house. I want to hold that house, or I want a house up in the mountains where I can go skiing, or whatever it is. So the question is, and we'll get to the money laundering in a second on this part as well.
Yep.
Is then the question is saying, well, are we taxing people appropriately for that in terms of being, if I'm paying income tax and I buy another house, yes, there's a stamp duty, but on an ongoing basis, I get, all my services and schools around that property and fire engines and, all these other things that go into it. I get them effectively for free because I'm still only paying my income tax on an ongoing basis. And the question is, are we pricing it appropriately so that people aren't incentivized, particularly rich people aren't incentivized just to buy more properties? So that's on one side is the rich people. Then we get into the foreign buyers who are often trying to get money out of their own country. Sometimes we'll get onto the sort of the bad stuff in a minute, but let's just assume it's people who are genuinely thinking, well, I've got kids in uni in Australia or whatever. It'd be nice to have a house down there, and I'll use it occasionally, or I'll summer in Australia, and I'll do something in the Northern Hemisphere or whatever it is. And so there's people who are overseas buyers who are buying properties, and there's basically no, we've got rules against it, but there's basically no oversight in terms of that. The actual departments, charged with enforcing, foreign ownership rules are basically starved of funds, so that doesn't. So you've got another group in there, and then your final group is the anti-money laundering. So the people who are genuinely crooks, and so the estimates are that somewhere between 15 and 50 billion, because Australia's made the choice not to not to put money laundering on people who turn up with sacks of cash to properties. So the money laundering for financial services and banks and everyone involved in that part is, and ourselves. I had a lovely hour of compliance today with going through anti-money laundering stuff, because that's what we just have to do. Yeah. Like every dollar that comes in, we need to work out what are we doing the right thing with it. Whereas you can turn up with a sack of cash and to brush the cocaine dust off it and hand it over to your local real estate agent, and they're genuinely they don't have to. They're not even obligated to raise any questions. So so from that perspective, as I said, you've got 1 million houses there. How many of those are from these different areas, and is that what we want in society? Is that we've got people bidding up the price of houses and other people not being able to afford?
Well, certainly it's a very complex thing, and of course the census really doesn't give us enough information, but some from my surveys, I know that there is some that's Airbnb'd, so basically they're short-term lets, not intermittent lets. There's a bunch of the holiday homes.
But sorry, actually, when you get back to that though, on both those, is that thought, especially Airbnbs, there weren't as many of those 10 years ago.
No.
And you go, well, what does it really matter? But you're like, well, if I have a house and I'm renting it, that's somebody's home. Somebody lives there now permanently. Yeah. Like I've supplied accommodation. If I turn that into an Airbnb, I've got to evict my tenant. He's got to go find somewhere else to live.
And absolutely, through the end of COVID, people were evicted to allow those properties to revert back to Airbnb again, because they'd moved from Airbnb to long-term lets through COVID, right? I mean, that for me is problematic, right? Then we've got people, and these are the ones who've bought particularly new properties and have never moved in and will never move in because they're holding them in their pristine state as an asset, right? And if you look down at Docklands, for example, Docklands is a fantastic in the high rise there. The amount of water that should be being used in that area is way lower than it actually is.
Yep.
And so the thesis is there's a lot of people there who've never moved in and will never move in. They are just holding those vacant properties, and therefore, surely, more equitably, they should be actually available for people, because we're in the situation where in some areas there's not enough property, right?
Yeah. Or at least just paying taxes on it so that we can afford to build more stuff if that's what.
Correct, exactly right. And of course, in some cases, you don't have to pay all the taxes and things on the empty building. And it's interesting because in Victoria there are some rules to try and actually pick up some of this, and you get charged extra. Up in Queensland, they're doing some stuff too. But across the country, I think this is a really big issue. And I've said for some time that actually we should have this very strong debate about spare property, because the supply mythology that there's not enough property around the place is being cruelled by the fact that they're not taking account of all that spare property. Now, you can on the other hand say, well, of course it should be up to anybody, it's their property, they can do with it what they like. But I think there's also a social issue as well over the top of it. And personally, I think we need to have a real strong debate about this.
Yeah, but I guess that's where I'm going back to from that tax side, and where some of these land taxes can help these. I think in terms of saying it costs money to have a property somewhere because of all the services that need to be provided, and there's hospitals and there's all these things and street sweeping and all those things. There's some sort of cost to having property. If you're an overseas investor, you paid your stamp duty once, and then you own that apartment in Docklands, and you're not paying the ongoing, facilities that need to be provided by the governments. Is actually, I think if you charge that out of at a more reasonable rate, then people will then, maybe you'll only have 900,000 houses or 800,000 because people will start going, well, I don't want to pay that much to do it. And I think there's certainly places in the US that charge very high rates, and I've got friends who say about how we've moved here and I'm going to live here for I'm here for another 10 years, and then my kids are finishing school and I'm out of here because the fees are so high that everyone who lives here is living there for the schools. And that's, from that perspective though, is your kids are out of school now. Yep. Do you want to live in that same place and have all these spare rooms, or do you want to, let's shift off and let another family move into that sort of school area? And
what you're talking about is joined up thinking, right? That's what we need, a bit of joined up thinking here, right? I know. And Ray said, what about imposing a tax levy on empty properties? How would that change the negative gearing thing? Because, of course, actually people are, they're actually encouraged to hold investment properties, right? Whether or not they get returns, right? Because of negative gearing. And, other people are saying, what about stamp duty? This whole area should be unpacked, in my view, rather than just perpetuating the status quo from the last 20 years, which has really done us very little.
Yeah, and look, I mean, I'm down to, I've got my kids are almost out the house. I've got rid of one of them. I've got three more that are almost there. So I'm at the other end of this, and you as well, Martin. But I do certainly remember the days of every year adding kids, and you need to buy bigger places, and they're the people who are paying the stamp duty. So we're basically saying, if you've bought your place 20 years ago and you're not doing, kids have all moved out and you're not doing anything and you're holding on to this, don't worry, you don't have to pay for nurses and teachers and all that type of stuff like that. And the poor struggling person who's just gone from I have a brother who's just found out he's having twins, and so all of a sudden he's like, oh my God, I need a bigger house, I need a bigger car, I need all this stuff like this, and you're like, oh great, stamp duty, thank you very much. You can pay for the hospitals and police and all that type of stuff for the people who haven't moved in 20 years and aren't going to move the next 20.
Yeah, well, you may have heard that New South Wales have announced they're going to give people a choice of stamp duty or land tax, except it's only for first-time buyers, and it's only up to 1.5 million. So it's not going to help those people who've own big properties moving into smaller ones. So it's really just a little bit of a move, but nothing more, right?
And as much as okay, so nobody wants more taxes, but the reality is that the property taxes or land taxes will work well if you have if you actually get to tax the people who bought the thing 30 years earlier and aren't moving and haven't paid, aren't effectively contributing to running the state governments.
No.
And that's the bigger problem is that it generally tends to be richer people who can afford to do that, and it's the more struggling people who are. Yeah. Well, so anyway, I did see a comment there about no taxes, and I get that nobody likes new taxes, but if there's a choice about saying, can I lower my income tax and increase, for me it might mean no net change. So I lower my income tax, I pay a property tax, but what it's doing is getting the incentives in the right direction and actually saying, yes, I want to incentivize people not to live in houses that are too big, and I want to give them incentive to move into houses that are smaller. Or I want to incentivize people not to hold vacant properties because they might visit it once a year or twice a year. So. Yeah,
it's the social good. But going back to the laundering thing, this is a really big deal, right? Because there were reports written 1 decade ago about what Australia needs to do. It needs to tackle the real estate lawyers, etc., because they're not in the laundering.
We've had how many reviews on this thing. Like we got the financial services had it within, I think it was 2006 maybe. So what do we have? Within 4 or 5 years, financial services were all up and running.
Yeah.
And then every year, pretty much from that, and every government just says, "Oh yeah, we just need one more review, and then the review says the same thing it says last time, which is do it." And then they go, "Oh well, one more review. We don't want to crash the property market. We want that to be somebody else's problem." Yeah.
And I'll tell you that in Canada, they got precisely the same issue. So there was a report done looking at the various reasons why property in Canada had risen so high and why it was so expensive. And actually, the money laundering thing was one of the biggest levers they discovered, right? But when they then tried to actually put stuff in place to try and deal with it, they tripped over the exact same issues. People didn't want to touch it because it would blow up the market.
Yeah, that's right. I don't want money laundering, but I also want my house price to stay high. So
exactly.
Which one do I choose? Yeah. It was interesting that we had a guy on there on our podcast to talk about it who just recently written a book, The Lucky Laundry, and talking about the Australian, how much money laundering's got in Australia, and he had a story of somebody who was in the early stages, was pregnant and going on maternity leave, and was worried about that all the laws would be passed while she was away on maternity leave, and now she's not quite sure if her own child is going to have children of his own before they get passed.
I know.
It's been that long.
No political will to deal with it. That's the problem.
No. Having said that, he seemed to think that it would happen this time. I'm not as confident myself, but I hope it does. But I guess his logic was basically that, hey, look, this government's been voted in for having a federal ICAC and cleaning up corruption, and there's lots of teals that are sort of all in that same boat. It makes a lot of sense that they would also sort out the and they've spoken about sorting out the whole thing as well. And so I get that logic. I just unfortunately a little bit more cynical that I'm worried that we've sorted out the ICAC one. That's the one we said. So maybe we don't need to. Maybe we don't need to worry about doing everything all in one go. We'll save that one for next term. So.
Yeah, well, they've got a few other things on, of course, at the moment. And I wanted to sort of come back to Chalmers at the weekend, right, was talking about the upcoming budget in October, and was saying, the budget's in a worse position, but we're going to have to take some serious steps. That's not. I could have told you he was going to say that. Yeah. Every government's going to say that. The next government's going to say the same thing in the next one. Yeah, exactly right. But I guess the question is, we're sitting on $1 trillion of debt, right? And interest rates are going up, so the cost of that debt is going to be a lot higher than previously, right? And I guess the question is that going to actually mean that they're going to just let it continue, or are they going to seriously try and taper it down? And if they do, what levers have they got? Are they going to actually put taxes up?
Look, now getting into speculation. Look, I don't know is the answer. My take is that they're going to spend less than they did last year, and they're not going to have as big deficits. They're going to try and bring the deficit down. And from a whether they do that from taxes or just some restraint in terms of spending, it's hard to tell. But I don't think they're going to make a serious dent in it, and which I guess as a newly elected government, and given how much of that debt, pretty reasonable amount was sort of one-off cash splashes here and election bribes there, and a lot of money given, as we've spoken about many times here, a lot of money given to companies who didn't even ask for it.
Yeah, just a bit.
Is that or who asked for it then realised no, everything's fine. I don't actually need it and weren't asked to give it back.
Yep.
It hasn't been an investment in our future. Let's just put it that way.
Another example, term funding facility, right? Really cheap money from the RBA to the banks, right? 0.1%, right?
Yep.
The equalisation accounts at the Reserve Bank now paying 0.75% or something, right? That means that the RBA is now paying the banks for the money that they lodge back with them, right? Which is worth about 1.5 billion currently, and if rates go up, it's going to be close to 3 billion.
Yeah. So we've had this constant. We've spoken a few times on this. We might know I'm sort of a little bit. We're underweight the banks at the moment. For the first couple of months of this year, that wasn't didn't feel that good. It's felt a lot better for the last few months. But we've got this ongoing thing for the banks where I look at the Aussie banks and go, they're some of the most profitable banks in the world, relative to the number of customers they serve and all that type of stuff. I say, well, is that because they've actually just got much better relationships with regulators and they're funded a lot better in terms of they're just given a lot more scope than other countries that expect them to compete with each other and want low fees and stuff like that. And that's possibly the case. I think that can cause some big problems when you've been lending too much money and you do run into an interest rate problem. I mean, that's sort of the base case I've got is that, look, we can't handle higher interest rates, and if we do start getting those higher interest rates, we're going to see a lot more bankruptcies and a lot more problems with the housing market and people who are overgeared. So stay away from the banks at the moment. But the flip side is the argument is, well, they've captured the regulators, and we had this Banking Royal Commission that came out with these really strong things, and we've done none of it.
Crickets,
and I haven't really seen much in terms of Labor going, oh, all those things that they didn't do in the Banking Royal Commission, we're going to come out and do all those. They certainly haven't sort of pitched that as an election pitch, certainly. So maybe the Australian banks are going to keep being more profitable than offshore. Just because they're closer to the regulators than they should be, and captured and paid for. Well, that's that example just falls back into that exact one reason why maybe you should be buying Aussie banks versus international. Well, having said that, I don't think banks are a good investment right now, but in the broader spin, longer term.
Just interesting. This is the S&P ASX 200 financials from 2007 to now. Right? And I'll just highlight to everybody that back in 2007, right, we were at 7,555 or 7,500, right? Today, we're at 5,890.
Yes. Okay.
That tells you something interesting.
Yeah. So we're back to where we were before that. I guess the other thing, though, on those banks, I'm guessing this is just a price index. Yeah. It hasn't got the dividends. Yeah. So you got some pretty decent dividends from banks over that time.
That's right. And that's just the market price. But it tells you something. So we're actually down in terms of, market valuation. Now, I agree, they've paid significant dividends. And of course they do. The reason they do that is because their margins are still a lot wider than many other banks, although their margins are getting compressed. And their funding is going up dramatically because a lot of that funding is now you can't use the TFF forever. You actually got to pay it back. I personally think there should be an excess profit tax on the term funding facility money that the RBA is now paying them, right?
Yeah, absolutely.
The $3 billion? Why not? Yeah. It was never intended for that purpose, right?
Yeah. Well, at least just let's equalise it to the money we're paying you back. Let's not
correct.
Just give you free money.
We've looked at the contract. They can't demand it back earlier.
Right.
So the best thing to do is just to excess windfall profit tax on that. But the point is that the banks now are really in a very interesting situation because they're finding that the lending momentum is easing. The margin compression is really happening. The bad debts will start to go up, right? Unless APRA does what they did last time, which was effectively allow the banks to classify bad debts as not bad debts for the period of COVID, right? Which is what they did.
Yeah. And you expect though that will take some time to, well, unless if you've got a grinding crisis, that's unlikely to happen until it generally becomes sort of acute. I guess if you've got a chronic problem where we just keep seeing margins grinding lower, interest rates higher, more bad debts sort of whatever ticking along, then you don't tend to get those interventions. If you do get this sudden stop type of intervention where all of a sudden we just get a wave of big developers falling over or a number of major companies start going broke, and then the bank's own solvency starts being questioned, things like that, that's where you're most likely to get an APRA or someone step in at those types of factors. So, I think the history of the banks has been wait for the crisis to happen, wait till the prices keep falling. When the regulators say, "Oh, here's all this extra free money and all that type of stuff," that's the time to pile in. Yeah.
Absolutely, timing being everything.
Yes, right. Yeah, absolutely. So I guess where I'm getting to is with that is I certainly wasn't pitching buy the banks. I'm short the banks at the moment. Oh, sorry, underweight the banks at the moment. But I do think there's that. I think I was more convinced after I should have been way more cynical after the Royal Commission. The Royal Commission came and all these things. I thought, Australian bank profitability is going to get dented back to closer to the bank profitability we see in other developed markets. But I've reappraised that view, and so they're going to keep doing what they're doing for some time yet, unfortunately.
Yeah, no, I think that's probably right, and it'll be interesting to see how it all shakes out. I mean, it goes back to what you said, when the regulators are ineffective and when effectively the banks are pretty much running the country, what do you expect?
Yeah, and then look, Transurban's a company we've owned. I sort of put it vaguely in a similar bucket, that they are the masters of turning up to asking governments, would you like a fantastic deal, Martin, until the next election, and then an absolutely terrible deal for the rest of perpetuity.
Sounds good. I'll take two.
Exactly. So anyway, that's why we own it, because I don't think it's changing.
Now let's just flip across quickly to the Nasdaq, because the Nasdaq's down 30%, give or take, right? So bear market plus, and I might just show that. So that's the Nasdaq again from 2007, right? So compared with the other one that I showed you, which was the Aussie banks, the Nasdaq's gone way up, and it's now come back down. I guess my question is valuations. On the Nasdaq, there are some that are actually not bad, but there are also some that are actually pretty awful. This index really doesn't tell you what you need to know, does it? It's too averaged.
And the valuations, you need to be really careful as well about what you're looking at, because there's a bunch of junk ones out there that still trade on 40 and 50 times earnings and without much growth. But there's also stocks within there. I haven't got the exact numbers from Micron, but Micron's like a chip manufacturer, and they're sort of trading on PEs of maybe 5 times or 6 times or something like that. But these are the types of companies that they're like resources companies. When the multiples are really low like that, it says to you the earnings are about to get smashed.
Yep.
And so you don't want to buy them then. You actually want to buy them when they're on multiples of like 30 times and earnings are at the lows. And so it's not as there's a lot of moving parts and a lot of different companies that sort of sit within that. We've got some of the ones that we want to buy, and I won't give away the name of the list because there's some very high quality stocks that you don't often get to buy at the prices we're seeing at the moment. I'm nibbling away at a few of them, but not quite ready to really jump in. I think when we shift back to more equities, there's definitely a number of sort of really high quality stocks there that just have great histories of profitability and markets that are very hard to for others to break into. So I'd certainly be looking at the Nasdaq and working out the good stocks in there that you want to buy. I think the really growthy names, I think you're done for this time. They're the ones that can keep falling.
Yep.
But I'd also be careful of some of these real cyclical companies where you think you're getting this bargain, but actually, the crap's about to hit the fan, and it's priced in. Like that's what everyone knows that's coming. Well, most people know that's coming, and that's why they can get them that cheaply. And there'll be a chance to buy them again, when earnings do fall.
Yeah, timing again is everything, right? And the point though is just because it's 30% down doesn't mean it's cheap.
No, absolutely. That's a short seller's joke, It's a what do you call it? A stock that's down 90%, or it was a stock that was down 80% and then it halved. The maths once you start falling down, that's you can and to put it into context as well. I spoke about the market saying it was on a 22 times earnings. And then now it's back to a sort of 16 times earnings, and it's down 20 odd percent. And you go, well, that doesn't quite work out from a numbers perspective. It's because the earnings has been growing.
Yeah.
The serious problem you get is when earnings start falling as well. And some of these companies where it's trading on 40 or 50 times earnings, and they're expecting 20 and 30% earnings growth, and all of a sudden that 20 or 30% earnings growth turns into negative 20. Well, you've got a full negative 20%. and you're still on a 50 times earnings. If the 50 times earnings comes back to 25%, well, you got to fall negative 20, and then you got to fall another 50% below that. That's where you get these massive falls.
And then I'll factor in the cost of debt, which is rising considerably for these very companies, right? Because they were actually being able to fund themselves on really, really, really cheap money, often do buybacks as well. That's all gone now.
Yep. Yeah, but even just the equity side as well, like the number of companies that could just basically say, look, I've got an idea, I want to do something, can you give me some money? And you get billions of dollars come floating through. And now they're sort of, when they turn up and say, well, I'm starting to run out of the last batch of money, can I have some more? They all of a sudden, the people wanted to see earnings and they want to see growth numbers and they want to see what you're doing with the money.
Yeah.
And that's very different to how it was 18 months ago. It's just like, here, shut up and take my money.
Well, exactly. It was just buying back a few shares and prices went up and everyone was happy. Well, it's a bit different now, isn't it?
Yeah. So yeah, I'd be certainly very much looking at companies. And I think I spoke at the start a little bit about that. That is, This is where you start to see which of the business models stack up. Yep. And the companies that have taken on those debt numbers, as interest rates start to rise, are they really a good company, or is it just financial engineering?
Yep.
Does it so? Yeah.
And talking of financial engineering, Kieran asked about this. How much debt is in the current market? Any chance of significant margin calls? I guess if that's an interesting question, right?
Yeah, and the thing is, the margin lending's high, but not so high that it's not an acute problem. It's and how can I put? Yeah, so I guess I think about that a number of different ways. So the debt's one, the margin debt is one side. That's a nice easy one that they can look at. Usually though, when you get debt crises, they're not like the last one, because everyone who was involved in the last one goes, oh, I'm going to make sure that doesn't happen again. And so then but everyone who wants to borrow and leverage up, they find a different way to do it. So some of the things that are worth watching at the moment is there's a strategy. Sorry, so the Bridgewater Strategy. Complete mental blank on the name of it, which basically means mental blank. Anyway, so basically what it is it's you buy debt and equity. You buy and you leverage up your bond portfolio because and then use that to buy more to increase your risk parity. So that's is the name of it. And so the idea is that equities are more volatile than debt. So what you can do is you buy your equities and then you get your debt, and because debt's less volatile, you can actually add more. You can leverage it up until it becomes it approaches the risk of equities. And because there's a long story and a long pitch about it as to why that's a good thing to do. If you take a big step back, you basically go, well, I owned some bonds and some cash, and now I own some bonds and some equities. And now I own bonds and equities, and I've got a loan behind it.
Yes.
Okay, it's not a margin loan.
Yes, but
it's not like there's a separate bucket going. So it used to be that I'd have that with a margin loan. Now I've just got that with a loan on the debt. I've still in the same position. Now they've had a really tough 6 months, and will the people involved start to question their strategy? Because if that happens, there's a big unwind in that, and you could see that some of these times when you see these big market ructions, and especially in bonds and stuff like that. There's rumours about whether is Bridgewater having problems, and it's sort of all weather strategy that's based on that. So if people start losing confidence in that, there's a lot of debt behind that. That's not a margin loan. And the other one that has calmed down a bit now, but derivatives. So calls and puts and all those types of things that was really flavour of the minute a year ago when we saw all those all the meme stocks and things like that. When you see lots of derivatives around, there's effectively leverage behind that as well. It might not be as obvious, but the reality is somebody's gone out and bought a call option for 20 cents, for example, and this call option could go to be worth $10, but it can also very likely go to zero. And so the person involved doesn't have the leverage, but actually the market makers behind it and all that do have the leverage as well. So, I guess it's the three different areas to be looking at is margin lending, yes, but that was where a lot of the problems happened in 2007, so probably not going to happen as much this time. Other forms of debt, risk parity, other bits and like that, and then what's happening in the derivatives markets. And you sort of add all three of those together, and it looks, and corporate debt as well, corporate debt. And then, add all three of those together and it looks worse. There's enough debt around to cause problems. And certainly with interest rates going up, if the Fed keeps raising it 50 or 75 basis points, could cause some serious problems.
And there was a couple of people asking, as we sort of come to the end of our conversation, Damien, about long-term bonds, 30-year bonds and what have you, right? Because we're going to see rates go up, but presumably come back down. Is there a strategy that says, long-term is actually quite a neat move?
Yeah, that's where we've been playing recently. So bonds, the Australian bonds sort of peaked at sort of about 4.1%, and sort of we're back to about 380 or 390 now. Looking like rising over the next little, if the market keeps rallying, maybe they'll keep rising. But I sort of feel as if we're in that realm now, that if that's effectively saying that interest rates are going to go to 7% plus, mortgage rates, are going to go to 7% plus in Australia and stay there for the next 10 years. Now, I think we're on the same side of this trade in that both you and I think that would cause a 10-year depression in Australia.
It would crush the economy.
Simple. Yeah. So if that doesn't happen, then those 10-year bonds are a good chance to buy at the moment. And it's not a bad return, I guess, picking up for about 4% return anyway for effectively the lowest risk asset in Australia.
Yep.
And then if we're right and interest rates do come down, then there's a pretty decent capital return in those as well.
Yeah.
So I guess I sort of tend to, we run often bond ladders. We always run a bond ladder where basically you have some 1-year bonds, some 2-year bonds, 3 years, all the way up. And the issue is, every year one of those expires and you throw it on the end. And then sometimes we push things more to the long end, and sometimes we push things more to the short end to sort of avoid rising interest rates or to take advantage of falling interest rates. I start to get nervous when I start looking at 30-year bonds. I sort of feel as if that's I think we've got a reasonable view about what's happening over the next few years. I think you can sort of see some trends that might give you, at least the feeling of some knowledge about the next 5 years. I feel like 10 years is starting to get a long way out. But I don't mind buying that sort of 10-year and that. Once you start buying the 30-year bonds, look, you're going to get lots of leverage in those. Like they would have fallen, if you owned a 30-year bond, I don't know, you probably would have lost 20 or 30% at least, I would have guessed, over the last 6 months. Like you get performance like equities in some of those things. And it's great for a stable return. Like, so if you can pick one up and you go, okay, I've locked that away and I'm not going to sell it, I'm just going to hold it to maturity and collect my coupon every term, great. You don't have to worry about interest rates going up or down. You're just going to sit there and collect that coupon every single year for the next 30 years. That's great. But you are going to see the capital be quite wild on it. And so I guess, if you're going to buy 30-year bonds, be prepared that you're going to see some volatility. I do think the odds are that it's going to be volatility is going to be in the right direction. You're going to be making money out of them rather than what we've seen over the last 6 months. But you get, let's say you get another nuclear accident somewhere, or you get war breaks out. There's a whole bunch of things that could happen that could force inflation higher for longer, and maybe you lose a lot of money on that in the short term. So I sort of feel like there's at least in my portfolios, I go, well, if I'm in the 5 to 10 year range, I'm sort of I can justify saying, well, it's a 5-year investment. Okay, look, we'll hold it to maturity. We're not going to lose any money on it. Yep. Yeah, okay, the capital value's gone down in the interim. I sort of feel like once you get to 30 years, it's it's moved the wrong way. I'm going to hold this for the next 30 years. It's a bit too far.
Yeah, very interesting. Well, we've, believe it or not, run way over time already. I can't believe it, but I always enjoy chatting about these things. And thanks for your answers there, Damien, and also for the people in the chat and all of the super chats and everything else. Really appreciate it. I think we covered a good range of ground today. I think the next 3 months will be really interesting. I think by September we will know whether inflation is really the beast or whether it's actually been tamed. And I think that markets will continue to be quite wobbly. But I just want to go right back to what you said at the beginning, right? In a bear market, you can get significant moves up as part of the bear market. So don't assume just because things have started to move up a little the last few days that this is the end of it.
Yeah, absolutely. And don't work out what your medium-term strategy is and then trade around that medium-term strategy. Don't react to the market because it's very easy for people to get excited. Oh, market's up 5%. It's all back on again. Bang, just in time for the next downturn. Yeah, you get the biggest rises and the biggest falls in bear markets. So.
Excellent. Well, thank you very much. Appreciate your time. And we'll do it all again next month, I guess. And by then, who knows where we'll be.
Sounds good. Yeah. Well, actually, I must admit, though, I feel as if this last month has been a little bit tame. I mean, I know there's things have been happening, but it's
it's a little bit more predictable, right? Than the
first 4 or 5 months of this year felt like every time we turn up, it's like something wild and different has suddenly happened. Whereas,
well, let's see if we can have a nice calm conversation next month.
Yeah, so we can sort that out. Yeah, sort that out for me, Martin.
I'll see what I can do. Thank you very much. I'm going to take you off there and I'll just close the show. See you later. Bye.
Thanks a lot.
Thanks. So there you go, folks. Very interesting conversation from Damien and a lot of points covered, I think, which was very relevant. So 2 things to do. The first is, of course, we just have to go back and visit the doggy cams. The doggies have not moved. They've been there all evening listening intently to what we've been talking about, but they will be disturbed shortly as I take them through their walk. Just to explain that next week I've got Chris Bates coming on. Oh, I misspelt property. My apologies there. I'll sort that out later. But Chris is going to come on. He actually should have come on a month ago and then didn't because of personal circumstances. So he's going to come on and we're going to talk about property. So that'll be interesting. The week after that, I've got Tony Locantro. The week after that, I've got Adam Stokes teamed up. He's the crypto guy, so I'll be interested to pick his brains. And then we'll have, I think, Damien back on after that. So that's the sort of the running order for the next few weeks. Anyway, thank you very much for your time tonight. Thank you very much for supporting us via Super Chat if you did, and for all the comments. Keep watching the shows. There's a lot going on. We'll continue to update you on what's happening in the markets there. And come and join us again live next week for another Tuesday session at 8 p.m. Meanwhile, take care. Keep safe. Keep warm in this rather cool southern weather down here at the moment. This is Martin North from Digital Finance Analytics signing off. We'll see you next time. Cheerio.